Hello and welcome to The Download. I'm your host, Dave Richardson, and I am joined today by a new guest, but someone we hope to have on regularly because we had her on a broadcast with a few thousand advisors, nothing significant at all. And she was kind of not even kind of, she was the hit of the entire day of a series of videos. And that's Jennifer Schillaci. Who is, let me get this right, Jennifer, Managing Director and Head of Real Estate Equity Investing. That sounds pretty impressive.
Yeah. Well, thanks for having me. Flattery will get you everywhere. So I'm happy to come to the podcast as much as you'd like and talk about real estate.
Yeah. The only criticism we got, and maybe the only criticism we'll get on this podcast is some of our the Italian advisors who were watching the broadcast think that you mispronounced your last name. What?
That's true. I get that a lot. I do get that a lot.
Yeah. So we're going to go with the correct pronunciation. People mess up Richardson all the time too. So I know how it feels. But anyways,
yeah, I don't think so. But continue.
So why don't we start with Jennifer? We've had a couple of your colleagues on over the years talking about real estate. But at the core, because I know you really love real estate, why should a retail investor want to have real estate in their portfolio along with their stocks and bonds? Don't I already own a house if I'm investing and saving for retirement? So why should they be thinking about real estate, and what kind of real estate are you talking about them thinking about?
Sure. That's a bunch of great questions in there. So let me just start with why real estate, with a small caveat that I do get questions from people saying, should I buy a house in this neighborhood? And my answer is, I don't know. I'm in commercial. It moves very differently than residential, and it is an investment. It's not where you're actually going to live. And there's a lot of other factors that would go into a residential purchase. So stripping that part away, focusing on commercial. So there's two questions on that. Like, why do I like real estate as an asset class, and why you should own real estate as an asset class? So I think I'll start with why I like personally real estate as an asset class. And there's some fundamental attributes here that are pretty exciting, which differentiate from stocks and bonds that you would hold within your portfolio. So real estate, when I'm talking about real estate commercial, I'm talking about effectively within a core portfolio where we call them the 4 food groups. So I'm talking about office, industrial, retail, and multi-res. So when you're buying those types of products, they can get anywhere from like the lowest we would probably do would be like 20 million all the way up to maybe, 500 million when we're just talking about the magnitude of the size. But when you're looking at real estate as a whole, it is, I guess the first thing is active management. So unlike a stock and a bond, where if you and I bought a stock, let's say we bought Microsoft day one and we sold it a year later, ignoring tax impacts, we would have the same return. But if you and I bought an office building and we sold it a year later, which is not typically what you do, but let's say we did that, the returns could be very different based on how we actually operate the asset. So when you want to think of these buildings, you think of them as like a little business. So you have your revenue, you have your expenses, and you have your capital. So if we were both running an office building and owning and managing it, it would depend on the leases we put in place, the lease terms, the types of tenants that we attract, the types of marketing that we can do, as well as how we efficiently run the building. So the more efficient it is, the more likely you can push your rents and the more attractive it is to tenants, as well as capital. So if you were crazy and, put your lobby made of gold and put like 100 million into that, no one would actually do that. You would destroy the value of your building. But you have to be really smart with the capital that you put in. The same sort of with the house. Like if you're redoing your roof, you would pick something that is economical, but would also last a long time for that. So that's the main part and like why I love it, because you really get your hands dirty, and it's really about generating that operating income, which is the primary return part of a total return within a core portfolio. So I'm just talking about core assets right now. So that part's pretty exciting. You also have your contractual leases in there. So your income is contractually obligated by primarily large tenants that are in your space. So people with the balance sheet that actually pay it. And within these leases, you also get rent steps. So it's not just a flat lease over, say, 5 to 10 years, but in Office, it can step by like 5 to 7% over that term. And then when you're looking at the other ones, so your industrial and retail, like those can grow anywhere from like 2 to 4% the income annually. And this is contractually obligated. And the other big thing that's different between the public markets and the private markets when you're looking at real estate is just the size of it. So the size of the market that you can actually buy into within Canada, or I guess within anywhere within the commercial market, is much larger on the private side. So the buildings that are owned, like the office buildings, for instance, downtown, like you can't buy those within the public market. They're really only available on the private market. And it's large private institutions, including ourselves, who do own these kind of assets. So you just get access to a much wider investment set within real estate. So that's, I guess we'll get more into that, but that's why I love real estate. And then why real estate as part of your asset class. So again, obviously, you just have a wider opportunity set. So your ability to access product you can't do on the public side, which is great. And also how it behaves. So your risk return is different than stocks. It's different than bonds. Remember, this is a private market. I can use material non-public information all day long. And we do. Actually, the better the manager that you have, and management is extremely important in the private side, the more access they have to these private like market makers. So you can know what rents were, what cap rates are, who's in the market, who's buying, who's selling. These are all things that do not tick across a ticker within Bloomberg. So I need to be very well integrated within the real estate community to understand what's happening, and that will set people apart. So you have fundamental differences there, which all to say means that the returns are uncorrelated with stocks and bonds. So
yes.
Going back to your basic financial theory here is if you take assets that are uncorrelated, you put them together, you will have a higher return on average at the same or even potentially a lower level of risk. So it's really helpful to provide that diversifier. And the returns within the core sector, like they're excellent returns over the long term, and you really see strong risk-adjusted returns. So we do not typically have the core space, again, those large fluctuations either up or down, which really acts as a stabilizer within people's portfolios. So that was a long answer to your question. But
oh, no. If I fire 5 questions at you at a time, feel free to take as long as you want. That's a little bit unfair. Some very weak hosting here. So you probably won't want me as a concierge in one of your buildings. But that diversification thing is so important. And I guess the history of this in the investment world is that a lot of large pension plans move towards, away from just stocks and bonds many years, decades ago. But you're really starting to see this asset get integrated into, portfolios that are available to retail investors because they have proven to be excellent diversifiers. And as you say, the risk-adjusted returns are very attractive. And you're usually doing that through a professional manager like yourself who has lots of contacts, has worked in the industry, is very familiar, loves real estate. I think we've clarified that, and so that makes a difference in terms of the access to the types of real estate that you can get, and the ability to get into the best deals because, as you say, who you're working with, who's managing the property, all of these factors play a big role in the ultimate return. As you say, 2 buildings side by side, exactly the same, one managed one way, one managed the other, different returns.
Yeah. It just keeps it very interesting. And then like at my previous firm that I was in with like a large life co, like this was part of real estate, was part of their portfolio. They had been managing it for like 80 years. So this is a long established asset class. It really fits well with people who have their long-term time horizons. So what was very beneficial for people who were backing, the life insurance policies or pension plans, so people paying out, it works very well for people here on an individual level. Like, I am for your excess liquidity. I'm not for your required liquidity. So this would be something you would put towards your retirement income or your, your preschool's college fund. preschoolers college fund. So it really provides that long-term time horizon where you can really generate those strong returns over the period.
Yeah, and as we've talked about on previous episodes when we talked about real estate, I can go get a mortgage. And by the way, Jennifer, I get the same thing. I get, because people know I work for a bank. They ask me about mortgages and all these different things, and I go, I have a mortgage. I don't know. I was a financial planner once. I tried to do a mortgage. My manager said, "Don't ever touch credit again." That's why I'm on the investment side of the business. So I'm the same. I have to brush
More
people
fun
off.
on this side, yeah.
Oh, the investment side is way better, which is why there's no really good credit podcast. It's all about investing, and that's why this podcast
It is.
is so popular. But what I do know is with a good job, I can go to a bank, get a mortgage, and I can buy a residential property. But if I'm just wandering along the street, or I'm watching this video and I see that big building behind you over your right shoulder, I go, "Oh, geez, I'd really like to buy that building," and then I'm going to be told it's worth, what would that building be worth? 50 million?
Well, that's a condominium behind me, but something that size in an office building would, if you're located, effectively where you are right here, which would be like King and Simcoe, you're looking at 250 to 300 million, assuming it's fully leased. Yeah.
There you go.
So I'm sure you have that. It's no problem.
Well, let's see. I'll look at my wallet here. I got a couple of US dollars because I was down in the US, but no. And so that's why buying real estate through this mechanism, through a fund via a professional manager, works, because you can get sufficient capital to invest in that building.
Yeah. And you also get the diversification, which is really key within core portfolios, because we have, like I mentioned, the 4 food groups. So you have your property type diversification. Within Canada, you have your geographic diversification as well. So within core funds, you typically stick with the top 6 cities within Canada, which I think I mentioned this before, but you call them VECTOM. Vancouver, Edmonton, Calgary, Toronto, Ottawa, and Montreal. That's primarily where you see a lot of core funds operate in the suburban areas around that. And then you also have diversification. So not only in the geography and the property type, but also in the tenant type. So the industry that the tenants are exposed to are diversified. So investing in a fund like this, rather than, just going out and piecemeal buying individual assets, will provide you with that. Because what you really want for the long term is to have reduce the downtime or the downturn within returns when something happens. And something is going to happen. We've been through this before. We were in the dot-com bubble, we're with the GFC, we're with the pandemic, the following interest rate spikes and inflation spikes as well. We know something is coming, that we don't quite know where exactly it is coming from. So that's where the diversification is really key. And within our portfolio, and within most core portfolios, there is a conscious effort in providing that diversity and distribution of the returns. So just so that when something does happen, so when we take the pandemic, for example, when we were looking at what happened there, the first one that got hit, the property type that got hit, was retail. So if you were 100% a retail, you're going to get hit. And then following on that, what we've seen, but what we are, I think, coming out of, which is very interesting, is the office. So the office then took a hit. But on the other side, industrial just went gangbusters during that period. So you really want to have that diversification, because you never really know where that's going to, either the up or the down, is going to come with any sort of major certainty. So you diversify away from that, and then you tilt the portfolio when you're making active bets in terms of where you think the next return is going to come from, which is, it protects the downside.
Yeah, and I think maybe the first one we'll address is a question that I get quite frequently when I'm traveling and talking to investors, is the whole idea of coming out of the pandemic, that we were not going to need as much commercial real estate and commercial space and office space as we had before. Of course, we all went from working 0 days in the office in the midst of the pandemic to maybe coming back 1, 2, 3 days. And now myself and my team here in Toronto are back 5 days a week. So is that fear gone? How have you seen that? How did you manage through that whole process to protect clients who were invested with you, and to take
Yeah.
advantage of what ultimately I'm going to guess you would say was a little bit too much fear mongering, that we were always going to return back to normal and everything was going to be okay.
Yeah, it's funny when you see like the psychology when these things happen and people think it's going on forever, but you really have to remind yourself, like with anything, that this too shall pass. And how we looked at our portfolio is we really try to be in the highest quality product within the property types and within the locations that we're going to. So when we're looking at office, we want to be in the Class A or the Trophy triple A class within major urban centers within Toronto. And that's where within Canada. And that's where we have focused all of our investments. And that's where we're holding. We have some select bets on suburban office where there are strong nodes. But again, you're surrounding those major employment centers from that. So I'll take it kind of in twofold. So the first one, going into the pandemic, I'll talk about Toronto specifically. The vacancy rate here was 2 to 3%, which is way too low for a functioning market. Then you're going to have distortions the other way between demand and supply. And we're probably going to come to that again, and I'll get to that within my next comments. But here, what we're seeing is it basically was a rising tide for all boats. So buildings that were Class C and Class B that were within the core were propped up effectively by this lower vacancy rate when they should have been coming out of the market and repurposed, torn down, converted to res long before the pandemic hit. So in the 5 to 10 years before that, but they weren't, they were artificially propped up. So when we did have this large impact on office, all of a sudden you see vacancy go up to, I'm not sure how high it went, but like 25, 30%. And people think, oh no, the sky is falling. But what's really happening is that these buildings that should have been out of the market in the first place are now getting hit with these higher vacancies. And the higher class buildings within the markets are actually not doing as poorly as what the overall numbers would look like. So you're getting that kind of dichotomy within the market where some should be closed and shouldn't be around. And then the other ones are actually doing fairly well. Now, that's not to say that they weren't impacted. We did see impact within our office portfolio as we went through this pandemic. And it's interesting to think that people, I'm not sure how to phrase this, thought they could stay at home forever and think that that would be a good operating model. Like as humans, we're very social, and we do, in my personal opinion, we do better when we are together, when we are able to bounce ideas off each other and be in the same room with each other. It's a palpable difference, and it really helps to drive growth. So if you're looking at the whole market for a year or two, if you have experienced employees that already have developed relationships, you could probably go work at home. Is that going to work for the long term? No. Is that good for our young people coming out of universities and getting into office employment jobs? No. Like, the last thing we need from a societal standpoint is a whole cohort of people working from home in like their parents' basements or living at home. Like, that's not how we develop a good society that can really grow and adapt. So we need to come together, and that's what we're seeing now. That's what businesses are seeing, that over the short term, yes, it works great, but over the long term, when we need to grow, we need to innovate. These are all knowledge-based sectors that typically house in office properties. Like, when you look at the office properties and the businesses that are in them, their assets go up and down the elevators every day. Like, this is really a people business, and bringing them together is extremely important. And so we're social. So will some buildings, have that vacancy level be elevated? Yes, but they'll be taken out. And what we're seeing in our buildings now, especially, there's a palpable difference in the last 2 months since, the banks, including RBC, as well as the government and some large employers, are recognizing this and calling people back. So our tour activity is way up. The demand for space is way up. We've been doing leasing, and then we're pushing our rents and our terms literally week over week, which is not something that we have seen previous to this, but it's a pretty exciting time as people come back. And the space that everybody needs for their people has grown, because the businesses actually have grown during that period. So not only do they need the space that they have, but they also need the future growth expansion space for the people that are coming back. And people sometimes ask me, well, we could just hotel the whole building, and then that way you can kind of work with people who are coming in in and out. And that, in our experience, doesn't work because hoteling is not a new thing. Hoteling is something that came and it was very popular, probably dating myself here, but like 12 to 15 years ago, that came in with a big wave, and they tried it. And what happened is it works well with people who need to come in one day and off one day a week. So maybe on the fringe, your consultants or people who are spending time with clients. But if you're in the office 3, 4, 5 days, people need their own space because not only are people social, they're territorial. And they like to have their own space where they can come and sit, and that's where they can be their most productive. And you want them surrounded by the same people that they can feed off of. So you want them within the teams. You don't want one person sitting on a different floor from the people that they actually need to work with every day. So this is all resulting in firms needing more space, which is why the office space is going to be very interesting to watch. So when you look, even we're seeing this now, where the class AAA, so the trophy, top of the line stuff within Toronto, right now, office space there is sub 5% vacancy. So we're already starting to see the pendulum swing in another way. So effectively, when you're reading headlines, they're going to be deceiving. So you're going to see, headline market vacancy number of like 20%, but at the same time, we're going to be out of space with the space that people want to be with.
Well, that's right. Because if I'm coming into the office 5 days a week, and you look at some of the premium office towers in large cities, even medium-sized cities, but the premium space, you've got a nice coffee shop or a nice restaurant in the bottom. It's a beautiful space. You have proper space to work and function, proper Wi-Fi, everything is at a level that you expect if you're working for a really high level organization. And again, you want people to want to come in and be in a great frame of mind to work. That's what I love with my team right now, with people coming in. As much as you say it did work in the short term being apart, we're actually really enjoying being back together. And you just see the way it builds culture and creativity and just unlocks the, everything that you can do within your business. But there's a big difference between being in a building like we're in and being in a building that, maybe hasn't had a whole lot of investment in it over the last 30 years. And
exactly.
And that's what you're talking about, the distinction between the really good commercial real estate, that A level is there's not enough of that. There's quite a bit of the other, and then you see the turnover. So how did you kind of play the market through the, all the fears? Is it safe to say that people who have stuck by the idea of investing in office space have done very, very well over the last couple of years from where it kind of bottoms out, and are about to see likely even a better place for office space?
Yeah, so I would say over the longer term, you're definitely going to see that positive return from office, but the last 24 months have been challenging for office, and we have seen the values reset there as the vacancy did go up. We're turning a corner now, and that's why I think going forward, we're actually going to see perhaps maybe even the strongest returns coming out of office. And that's not only the NOI growing, people looking at taking more space, but also the debt has become more conducive here. So we've had 8 rate cuts over the last, 18 months or so, which has really brought obviously the interest rate down, and the financing ability back to office is positive. So we're dealing with positive leverage here, which is very helpful for this asset class, which typically has leverage on it because it's backed again by those contractual leases within the buildings. So not only are the actual interest rates down here, but the interest rates being lower reduces the valuation metric pressure on these properties as well. So what we're seeing is typically how they're valued. You use your cap rate. It's the same thing that when you're valuing any other asset class, when the cap rates go up, the values go down. And right now we're seeing less pressure happening on office space from that dynamic where the cap rate isn't being pushed up by interest rates. We've already gone through that period over the last 24 months. Now, do I see what we call the cap rate fairy coming back and squeezing that? Probably not. We're going to be focusing on the operating. So back to just fundamental real estate. Like we're looking at NOI, we're looking at leases, we're looking at pumping out growth. We're looking at making sure our buildings are the most attractive to tenants within within the space and what they're coming back to. So we've actually been investing in our buildings. So we have our Class A and our trophy buildings. And we want to make sure that we are having all the amenities that tenants are looking for. And typically, what we see in markets that have a little bit of elevated vacancy, that you can kind of go into it, amenities armories is what we call it. So buildings need to have your conference facility. They need to have gyms. They need to have retail on the bottom, so people just pop in and out to get lunch. And that's really what we're focused on, is to make them more attractive. And we've been seeing the benefits of that within our portfolio. So we have come out of a tough period there, but we are moving forward. And do you want to know what the trendiest amenity is right now that's being demanded by people?
Yeah. What would that?
Doggy
I don't
daycare.
think I could guess it.
Doggy daycare is now
really
like the it thing. Now, are we going to move our buildings to accommodate that? This is likely a short-term fad, but we might do that a little bit more in our suburban office. That we have a couple holdings there versus the downtown one. But it's just interesting to see what's on the checklist now for tenants. Now that it is, yeah.
It's always amazing when I'm talking to portfolio managers, regardless of the space. There's something going on that's just, something you wouldn't think of. But again, this is what being a professional investment manager, you need to be on top of these trends. You need to understand the direction the market's going.
Yeah. Make sure our buildings are like attractive to like the widest swath of tenants.
Yeah. And then so let's go into the other one that people get concerned about and get a status update there just to finish off. And that's retail. Here in Canada, we saw Nordstrom retreat back to the US. We've seen Hudson's Bay and Saks go under. So these would be what you would call, I guess, anchor tenants in a mall.
Yep.
And so what's the future of retail? Is that an area that you don't like? Does it tend to be a full weighting in your portfolio, or is it underweighting? Did I get 5 questions in there? I know that's
I know I'm gonna have to start writing these down here, Dave.
I know.
So retail. Let's talk about retail. Within our portfolio, we are underweight retail. However, retail is segmented into 2 sections. You have your grocery anchored retail, which is your non-discretionary. So these are typically your strip centers that you see surrounded by the populations that would have effectively like it's called. So you'd have grocery, you'd have bank, you'd probably have like a Shoppers Drug Mart or a Dollarama. Those did really well during the pandemic and the following period. Obviously, as you would expect, you need your non-discretionary items. So those ones we would like to add to. But I think your question focuses more on the other side, which is the enclosed mall, which has more of a discretionary, obviously, side to that. So yes, we did see a lot of the anchors kind of, I guess, exit Canada or exit existence, which when you're looking at a mall, they do provide a benefit. But what we have seen is, and especially with the Bay, which, we have a couple of those within our portfolio here. So we're kind of more of a firsthand experience with those. Typically, anchors pay really, really reduced rents. And when we're looking at the Bay, typically how those were structured is they were paying, I don't know, like 85% less than what the market rate is for that particular box space. And they also would typically have extensions. And this is not just us, this is just in the market. They would have extensions that would run for, 60, 70, 80 years. So they would have leases that would maybe run out in my lifetime, but maybe not. Hopefully they would run out in my lifetime, but we're talking like 2084, 2086. Like these are when the leases expire. And they also have restrictions on that space. So some of them are punitive, like the Bay had to opine on who you could actually put in stores surrounding the Bay. They have no builds on the parking lot. So like a big part of the parking lot, which, when you did this lease in the 50s, you're like, okay, well, you can have all this parking. Like we're in a very suburban area, like that's fine. But now fast forward 50 years on these leases, and some of them you can actually get some pretty good density. Now the condo market's gone a little sideways now, but in general, and that'll come back. there is value to the density, and it can be not only condos actually, but it could also be pad sites, which are popping up, and they're very popular on the enclosed mall section. So this would be putting in like a keg or a Moxie or even a bank, because they do like to have their drive-through centers there. And so then we just look at, so that's actually an opportunity for us to put in retailers that will actually draw more tenants, as well as bump them to market rents. And if you have a center that's in a good location, like we do, we're actually already speaking with tenants, future tenants, to come in and backfill the space. And they're reaching out to us because they see it in the news, and they're like, okay, well, now that space is available, and we'd like to go into your enclosed mall. And really what we've seen, I'd like to say kind of even before the pandemic with enclosed malls, is they've gone from, a place where you just go and buy clothes or shoes or whatever you need, to a more experiential dynamic. So this is where people go to eat, to go to the movies, to have more of an experience, like a social experience.
Yeah.
Which what we're finding with the tenants that we're putting in as well. We're putting in a lot more tenants that do cater to that, like come into our space and have an experience. So an interesting one that we're putting in is called Activate, which is actually a tenant within, I think they have spots all over Canada, but it's like an interactive kind of video game where you go in and the kids love it, and you actually like interact. I'm not doing a horrible job explaining it, but it's actually very, very cool. And we've actually seen an increase in our per square foot sales. We've seen an increase in foot traffic, and people would say to me like, isn't the mall dead? And I would respond to them two things. One, you've never been a primary caregiver of a newborn, because then you would know that the mall is definitely not dead. And then two, we went through like the perfect social experiment to kill malls. Like if malls were going to die, they would have died in the spring of 2021 when they all shut down, especially here in Ontario, when we had our stay-at-home orders and everything was closed. But what's happened is they've come back, like in Ontario and as well as within other provinces as well. Like try to go to Sherway or Yorkdale on a Saturday afternoon, and you tell me how easy it is to get a parking spot. Like this is back. And again, this speaks to like people are social. They want to go to a place where there's other people and where they have events. And malls have taken advantage of this. So not only have the tenants catered more to the experiential, but the malls are doing this as well to try to get people in the space, and that's really working. So in Sherway, when you look at that mall in particular, they put in like a science center spot pop up there, so that all of a sudden brings families and kids into the space. And if you have young kids and you've ever been in a mall, you know that they want everything that's in there. And typically, and I'm guilty of this as well, you come out with one or two things, and then you want to go back. So all that's to say is retail is evolving. It'll continue to evolve. We like to say that retail is detail. So it is about the small little things that go into that. But as an asset class as a whole, it is something that we think there is some value on. Now, will we add to the position in well-located centers with strong sales? We might look at adding to our position. We won't go into any tertiary parts, but it is an area where you could take that contrarian, not even contrarian view, it's not really contrarian anymore, where enclosed malls as a social hub is like a place that you want to be.
Yeah, and well, we you mentioned condominiums in Toronto, and I just think of, every generation is going to be different. They're going to do things differently. So the millennials want to live in 500 square foot condominiums right in the heart of the city, because that's where all the action is. But then they have that first child. And then all of a sudden, we weren't going to need neighborhoods and houses out in the suburbs. We weren't going to need malls. And all of a sudden, those millennials, just like every generation previously, they need a little bit more space. That's where they go. Like you say, the social hub within those communities. And it's often overstated, just like any fear in downturns in almost any market. So it's and again, this is where a professional investor always sees through that short-term noise and finds opportunities for investors, which is what you do in the real estate space.
Yep, this too shall pass. Yeah, invest for the long term.
Yeah, that's well, Jennifer. Look, we only got into 2 food groups in detail. We'll get into the other 2 food groups and get you on soon. But always learn so much when just spend a few minutes with you. It's incredible, and of course, I think if I'm an investor, I'm investing somewhere. I want to invest with someone who has a passion for what they're doing, like you do. It's really amazing. So, Jennifer, thanks.
I really do.
Thanks.
Yeah. Thank you. Thanks for having me. I really do love it. Like, what's not to like about buying up skylines? Like, it's just incredible being able to do this. So, thank you very much for allowing me to speak about it.
Do you walk around with your family and friends and point to a building? It's like we own that.
Oh, I do all the time. All the time. I'm like, that's my bill. Well, I'm like, that's my building. We put in this tenant here. This just sold. Like, I say it to my kids all the time. Like, I was actually driving on the 401 yesterday. I'm like pointing out industrial properties, and they're like rolling their eyes. But I'm like, this is exciting. Look at that location. We're right off the 401. Like,
I love it. Jennifer, thanks so much.
Yeah, thank you.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.